Let's go, folks. It's a big one today, because every day is a big one. Good morning. Welcome to the Street's opening bell here from Post 35 on the floor of the NYSE. Today is Monday, the 9th of January. We're already 9 days into the year, folks. It happens fast. I'm JD Durkin. That's what the box says. Glad to be here. Thank you for joining us. Opening bell rung moments ago by Lupe Fund. This in honor of their 20th anniversary empowering Latinas to promote leadership and civic engagement. Congratulations to them. Stocks are trading up in the green to kick off the first full official trading week of the new year. Remember, last week was 4 trading days. This one, finally, we are up to 5. The S&P up about 0.5% here or so, hovering at the 39. I'm going to take a look. Where are we at? 39.16 level. We'll see if those levels hold for the next few hours. Let's take a look at what is on tap for this morning. You know, words are tough. Granted, there's a teleprompter, but it's Monday. I haven't had a ton of caffeine just yet. You got to get the gears going, folks. What are we talking about for the broadcast today? Let's take a look. A big week for the Fed, as of course we are expecting some new CPI data. Plus, we'll be digging into why both Macy's and Lululemon are seeing their respective stocks slump. We'll also be breaking down what to make of Goldman Sachs becoming the latest big name to implement job cuts. It is now the story of a lot of these white-collar positions that are now facing cuts. We talk about the impact certainly on the tech sector in recent weeks and months. Now we're seeing this conversation more and more from many of the big financial names. And of course, this time 2.5 years ago, it was the food and hospitality spaces. And you look at the jobs numbers, those names are now trending the other direction. But we will now put the focus on Goldman here later on in the show. For more on those stories and so much more to kick off this Monday, we now welcome in our chief markets correspondent, Mr. Martin Baccardax. Martin, thank you for being here. Hope you had a great weekend of watching football. I know we'll dig into that in just a bit, but I do want to start with Friday's big rally, which saw the S&P alone climb 2.2%. It's nice to see green on the big board to end the first week of trading. The pace of wage growth slowed in the month of December, and we also had a contraction in the services sector specifically. Why do you think those two data points were the things investors latched onto as opposed to the top-line jobs and unemployment figures?
Yeah, it was a mixed bag, wasn't it, JD? I think ultimately what you had with the ISM number, which just to sort of like give a top line indication of what it measures, it's a very important indicator of economic activity across the whole of the US. This number in particular was focused upon the services sector, which generally speaks to the most powerful growth driver of GDP advance. So when you have a contraction in the month of December on top of a similar reading in the month of November, that you begin to get concerned about the potential for recession, because again, this is probably the widest look at economic activity. So that was one portion of it. The bad news from the growth perspective was seen as good news from the rate perspective. In other words, the Fed would probably have to take its foot off the pedal of potential rate hikes as a result of the slowing growth. At the same time, however, that was mitigated by the better than expected reading in job creation, 223,000 net new positions added over the month of December. The headline unemployment rate declines to 3.5%. But most importantly, you had moderating wage growth. It came in on a monthly basis at 0.3%. That was half the rate that we saw in the month of November. So that was a case of good news mitigating the bad news, but both pointed to potentially slower interest rate projections from the Federal Reserve. And as a result, we saw a change in betting on near-term rate hikes and a change in conversation as to when the Fed will peak and for how long it will stay at that peak. And that, of course, translated into the rallies that we saw on Friday, the best day, I think, since the end of November for the S&P 500 and a bit more than 700 points for the Dow.
But now, how do you square this away with the information in the Fed minutes that we got earlier in the week, which indicated, I mean, we knew what the dot plot is, but correct me if I'm wrong. There's no sense from anyone regarding these decisions that rates are going to be cut at some time. So, I mean, the Fed has already telegraphed higher for longer, right?
Yeah. No, they absolutely have. And they appear to be sticking with that prognosis. There was commentary over the weekend that suggested the Fed funds rate will have to climb past 5% and stay there until the end of the year. It's largely echoing the message that we have heard from voting Fed members over the past few weeks. The market isn't agreeing with it. That has to be said. So there is some conflict between what the Fed is trying to project and what the market is anticipating. But I think the central argument, JD, boils down to what the Fed is looking at in the jobs market and whether or not that's valid or not. What I'm reading at the moment is that Chairman Powell and his colleagues are quite focused on the high number of vacancies that are represented in the JOLTS report, and we talk about that on quite a regular basis. The JOLTS data for the month of November suggested that we're about 10.45 million unfilled positions in the US economy. We talked about how that contrasts with the fact that we're starting to see accelerating headlines of job cuts. But nonetheless, the Fed is worried that bringing those workers back into the labor force is going to require faster wage growth. And that, of course, is going to feed into inflation prospects. But now that there's a thought process, JD, that suggests the Fed is perhaps overstating the data inside the JOLTS report, or maybe overemphasizing it. And the JOLTS report itself isn't necessarily reflecting the fast changes that we're seeing in hiring conditions and indeed in potential layoffs. And we talked about this last week. December layoffs actually accelerated by about 130% when compared to December of last year. So if that turns out to be true, and the JOLTS data is perhaps giving us a bit of a false alarm with regards to the number of people who are on the sidelines waiting to come back to work, that will have an enormous impact on wage growth. Wage growth is already slowing quite significantly. It's about 4.3% over the fourth quarter of last year. And that's down from about 5% over the 3 months that ended in September. And we're getting closer, JD, to the longer term average of between 3.25% and 3.5% on an annualized basis. If we get there, those numbers are very consistent with the Fed's 2% inflation target. So we could rapidly approach that in the early part of this year. And if that were to be the case, that is going to completely disassemble the Fed's projections on rate increases. We're going to be talking about a very different Fed funds peak. And indeed, we'll get to accelerated Fed rate cut talk into the summer and potentially into the early autumn.
Martin, please excuse the smile on my face. I just, after not talking with you for what's only been a couple of days, I love this stuff. And I know that you love this stuff. And I hope our viewers love this stuff. And as I hear you talk, I say, God, I'm like leaning forward in my chair with anticipation on the trading week to come, because there's so many good little nuggets that you've discussed that I want to follow up on. So if I can on the wages and the 10 point, are we still at 10.4? With regards to the JOLTS, I know it was for November. Did that number adjust?
Yes,
I think that was about right. So we were almost at for every one person seeking a job, there's 2 available jobs. Did I get that right?
Yes. But again, The assumption now is that it might be overstated, but that's exactly where we stood at the end of November.
And the idea there being with concerns to wage growth that you need to increase wages to incentivize people to come in off the sidelines.
Yes.
Absolutely. Okay, now I do want to ask you about unemployment. Like, hello, 3.5%. The Fed has said we need to see that number closer to 4.5%. That's far off the current level. I think there's a bit of a good faith question to wonder, is the majority of the pain behind us? Or when you look at that big gap, and that is a big gap, Martin, between the goal and the reality, does that mean more of the pain could still be ahead of us?
I certainly think so. The indications that we're getting now, JD, are that we're seeing a really significant pullback in temporary hiring. And temporary hiring tends to be a good indication of where companies see their sort of labor force needs over the near term. If that were to accelerate into January is going to be a tough month, obviously, as a result of those temporary workers being let go after the holiday season, companies retrenching a bit, looking at where they're seeing consumer spending and growth prospects and adjusting their budgets accordingly. So we probably won't have the fullest understanding of the labor market until sort of the end of February and potentially early March. But it does appear that those job cuts are going to accelerate. And if so, that 3.5% figure isn't going to hold for very much longer, I shouldn't imagine. But it is worth remembering that that headline rate really only calculates those people who are actively seeking a return to the job market. And as a result, it could underrepresent the number of people who would actually like to work but have just given up or fallen off the radar. When you take that number into account, the headline unemployment rate is a little bit more than 6%, and by some calculations is even higher. So the 3.5% number is one of those figures that mainstream media, and ourselves included, does tend to cling to, but it isn't always the most accurate representation of strength or weakness in the labor market.
Appreciate the context as always. Obviously, this is not a show about politics, but when you talk about the major institutions in the country, we talk about TheStreet, and you got to talk about Congress and the role of DC. And you are a very astute observer of the world that I used to live in, which is Capitol Hill and the White House. And I am always struck after a jobs report, the likes of which we had Friday, where we know, I think you called it a Goldilocks report. There's the good and the bad, and we know what it we know what it likely means for the Fed path moving forward. I'm always struck in a moment like this when you have the White House and you have Democrats kind of spiking the football about this. And I wonder what your take is on that, because it's easy to sell it to people. And I had a lot of people in my Twitter mentions being like, oh, now I'm ready for reporters and Republicans and all these people to tell us why this is actually a bad thing. And it's like, well, yeah, I mean, in terms of a big picture context for what this means moving forward, it's not necessarily a great thing. Do you think it's at all, if you're comfortable with me asking this, ill-advised perhaps for Democrats to say, look how great these numbers are, knowing that it could mean not positive reaction in the next year?
Yeah, I mean, it's always the danger, isn't it? I think really one of the great sort of errors that mainstream media has executed over the last couple of decades is to pin job growth onto the executive. In other words, to allow the White House to congratulate itself about job creation when ultimately its policies have so little impact on that. They simply cannot control the larger macro forces which drive job creation, and companies create jobs, government does not. I think we can all accept that as fact. So when you do get people pinning job creation success to an administration, the corollary doesn't disappear. And that's when jobs begin to decline. The White House has to take the blame. It might be a little too early in the political cycle for Democrats to want to take too much congratulatory messaging from the jobs market, because they don't have anything to do with it just now. Obviously, Republicans are controlling Congress. We're 2 years away from the presidential election. No one is going to remember what the jobs market was doing in January of 2023. It's largely irrelevant from a political point of view. So in some respects, I don't really see any great political advantage for the Democrats to try and stress the job creation record, because what they're going to have to do is articulate the reasons why it is slowing, and potentially even slower when they start to get to the stump, or whatever primary might come, and ultimately what will happen in the presidential election in 2024. And that's a long time away. Nonetheless, we did create 4.5 million jobs last year, and we are above pre-pandemic levels in terms of overall employment. The one caveat to that is we're probably about 7 million jobs light of where we would normally be had the pandemic not happened. So there is still quite a few people that need to come back into the labor market. That is probably going to entice some kind of wage growth along the way, but it won't be to the significance that we've seen, and the job creation is absolutely going to slow this year, even if it doesn't contract.
I promise we'll leave the world of politics behind us after this next question. Did you
Never.
were you like me, not valuing your free time on your weekend? Were you awake Saturday morning at midnight, 1 o'clock, 2 a.m., 3 a.m. maybe, the way that I was watching the catastrophic dramatics on the floor of the House?
I was not. I will confess this,
Good for
JD.
you.
I tend to have absolute laser focus on events that are going to have a real-time impact on financial markets. But the great thing about financial markets is it does give us at least some small windows of rest over the weekend, and therefore we can digest those actions over time and don't necessarily have to be glued to them in real time. Had this happened on a Wednesday night, I'd have had no choice whatsoever. But gratefully, mercifully, these guys allowed it to drift into the weekend, and then it became their own story rather than a financial market story.
You know, and this is where it's a real privilege to have said that I've covered both Congress and Wall Street closely. Not something a lot of journalists, have get to done, but it means that I cover the trading hours, and then I can't help but watch what happens. And so there I am on a Saturday morning at 1 a.m., 2 a.m., tweeting my way through all this. But there's a really interesting line. Leader Hakeem Jeffries, who is, as everyone knows, he will be the next Speaker of the House at some point here, right? He had this line in his speech. He said, we, meaning Democrats, we saved the country from a deep recession. And I couldn't help but say, oh man, Leader Jeffries, I don't know if that is the right thing to say. I don't know if you agree or not, but here's Democrat. He's talking about the spending priorities, the Inflation Reduction Act, and he's saying, we saved the country from a recession. And of course, it's an applause line for Democrats, but it reminds me of this massive gulf, this separation between Wall Street and Capitol Hill, the two institutions not understanding one another. Is that a little bit of a premature call, you think, whether it's from Jeffries or anyone else?
No, I think you might be right about that, JD. I mean, I don't mean to compare the two situations at all, but I do remember that President George W. Bush's mission accomplished assertion, which of course backfired spectacularly very shortly after. So I really do think that taking credit for an event that is still sort of yet to be decided isn't the most particularly astute sort of decision to take. And I do agree with you. Over the weekend, I thought that that was maybe, if not reckless, certainly a little bit risky. There's every chance that the economy could turn into recession, the ISM data being certainly one of the most important aspects. We're not there yet. I mean, with 3.5% unemployment, as misleading as that number might be, and the Atlanta Fed GDP now suggesting that the economy grew at about a 3.6% pace over the final months of the year, there is solid momentum. There's no question about that. But earnings are going to contract. Inflation is still sticky. China's COVID crisis is still something that could upend the global economy. The IMF is worried about global recession. Europe is not out of the woods and is facing a potential energy crisis. Russia's escalating military adventure in the Ukraine isn't going anywhere anytime soon, and it's approaching the one-year anniversary. And we're seeing political upheaval just over the weekend in South America. Those are a lot of headline moving parts that could upend the growth story right now. And I think being caught up in the moment of sort of schadenfreude, if you will, watching your political opponents tear themselves to pieces, might give you reason to take credit for avoiding recession. But it's a comment that you might want to have thought twice about if it were to be revisited in a couple of months' time.
And it's not a comment that got a lot of headlines. Obviously, there's a lot of other things to talk about. It's just the sort of thing that I picked up on, and I said, don't know if I would have written that had I been on Hakeem Jeffries' press team. But regardless, it's out there. And so, I like a conversation like this because obviously we could talk about what's been top of mind for politics. Everyone has been following that drama, but we do it through the lens of the major market indexes. To the point about markets, let's now pivot back, and I do want to ask you about CPI out Thursday of this week, if I have that correct. How important will that be for the Fed? Really, what is the trend line for steadily falling inflation that the Fed and really all of us, investors, people who buy anything, are hoping for?
It's immensely important. I think it's going to be probably the most important reading that we've had for quite some time, because inflation has already declined for a 5-month period. If it were to extend that decline into the month of December, then there would be every reason to assume that the momentum and the arithmetic would elicit the slower inflation readings that the market is looking for into the first months of this year. On a headline year-on-year basis, the expectation is that CPI will slow to 6.5%. from 7.1%. There is going to be a bit of a bump in the core reading, but I don't think that will be significant. The bump is more of a reflection of the fact that the headline is slowing as a result of the drop in energy prices and the pullback in gasoline costs that we've been seeing really since they hit that record peak in the early part of June. So the momentum is absolutely trending in the right direction. And if we were to come in south of that 6.5% figure, it would be absolutely sort of it would cement at least the market's case for slowing inflation into 2023 and cement its testing of the Fed projections. Now, whether or not the Fed would pivot immediately from that is unknown, and I would probably argue unlikely, but it will add to the evidence that we are seeing changes in both the labor market and in consumption that are moving in a direction that will make the Fed much more comfortable about its goal of engineering a soft landing for the economy, whilst at the same time seeing inflation slow very quickly, or I should say, slow very slowly towards that 2% target. We're a long way away, but on current trend, it could be there by the end of this year. And if so, that changes the calculus for virtually everything.
Martin, I'm just so happy with the conversation up until now. Thank you, thank you, thank you. I do want to ask you about Lululemon. Let's talk about a little more specifics here. That company says it expects the holiday quarter gross margins to decline. clearly a drop here in consumer spending is the case here, as well as it will be for the company we'll talk about in a moment, Macy's. But to Lululemon's point, how big of a note of caution is this?
Well, in some ways, JD, it's indicative of the conversation that we've just been having with regards to inflation pressures. Because as inflation begins to abate, company profit margins are also going to narrow. And it's interesting that they will probably they will be reflected in the early stages by the retail sector, but they will begin to spill over into other sectors as we go forward. Lululemon is one of the first companies to articulate with degrees of certainty how that gross margin compression will affect its earnings and what it is seeing in the months ahead. The statement itself was relatively threadbare. And in fact, they saw sales over the holiday quarter probably rising from their prior forecasts. But because that margin is going to squeeze, people are assuming that earnings are going to be pressured into 2023. But we're going to hear that from a lot of other companies as a result of the pullback in inflation. With regards to Lululemon, it's not only the inflationary change, but it's also the fact that they had an inventory build into the holiday season, and they needed to mark down a great number of items in order to shift them and to right size their inventory into the 2023 year. So that accelerated some of the margin compression. They're going to cut costs to try and mitigate it as well. But nonetheless, the market reacted quite severely to that. They took the stock down about 10 to 12% of pre-market trading. I haven't seen it since the open, but I would imagine it's close to that. But that's a message, JD, that we're going to get from a lot of other companies, starting with retail, but certainly across a broad sort of range of sectors as a result.
It's currently down 9.8%. Yeah. Thank God technology, you say it, we can pull it up. We have the information in front of us. Everyone missed the mark on inventory, didn't they?
They did. They did. It was a difficult thing to navigate because you had, of course. Just the supply chain disruptions as a result of the pandemic. You had sort of surging and then waning freight costs. With Lululemon, their freight costs are mostly associated with aircraft. With a lot of other companies, they're more sea-based, and as a result, the price changes there fluctuate quite significantly. But Target, Walmart, Home Depot to a lesser extent, but a lot of the big retail names found themselves on the wrong end of retail movements, Nike being another name that was important in that narrative. So Lululemon absolutely doesn't stand alone, and the retail sector has struggled with that inventory build, and as a result, we got to enjoy the markdowns over the quarter, but investors won't necessarily enjoy the resulting margin compression that it triggers.
I do want to move on to Macy's. While we're more or less on a similar topic, shares of the retailer slumping after that company warned its fourth quarter sales will come in at the low end of previous forecasts. CEO Jeff Gennett saying this: based on current macroeconomic indicators, we believe the consumer will continue to be pressured in 2023, particularly in the first half. What does this portend about the state of retail as a whole? What should we make about a comment like that, Martin?
Yeah, I think it's an important one. It's interesting in that it contrasts a little bit to the spending data that we got from MasterCard over the holiday period. They actually said that overall spending was up about 7.6% into the 24th of December. We don't know the data from after that. But that's a relatively solid gain, a lot of it online, some of it in brick and mortar. But what Macy said was that whilst they were happy with what they saw in the Black Friday, Cyber Monday period, and in the final hours into Christmas, they felt that the off-peak holiday sales were slower than they anticipated. In other words, shoppers were sort of excited and enthusiastic around the special events, but not necessarily in between. And that does speak to a pullback in discretionary spending. And as a result, it probably means a similar pattern of behavior going into 2023. I've long maintained that spending patterns and the conditions in the job market are tightly related. If we are to see an acceleration, particularly in headline layoffs and maybe a rise in unemployment and a change in the job market prospectus, then we are going to see a corresponding decline in consumer spending, particularly if people sort of have wound down a lot of their pandemic savings into the last part of last year. And there's a great deal of evidence to say that they have done so. So Macy's trading lower as a result of that. And again, I would imagine this is going to be echoed across the retail space. We actually, paradoxically, JD, got a slight indication of that last week when Costco told us that they were very happy with the number they saw. I think it was 6% plus over the 5-week period ending on the 5th of January. I think it was about 24 billion in overall sales. But see, when Costco does well, the discretionary retailers don't do as well because, of course, Costco was able to attract a different host of clients and also those who are looking for the bulk price discounts that that company has to offer. So we are seeing that retail story play out with a bit more detail now, and that we'll get a drip of information in the weeks ahead. And I don't anticipate that it's all going to be good.
Of course, you're also talking about, yes, the clientele may be different, or the actual consumer. You're also talking about two companies. You're going for different things. When I think about what I would get from a Macy's, it's not what I would go to a Costco for. I'm going to go to a Costco to buy in bulk what I would buy from a Walmart. And Walmart has said that it has seen a rise in consumers who make over $100,000. Higher end salary consumers are now going to a Walmart for those foods and services. I would think that matches the shopping patterns of a Costco, whereas in terms of discretionary spending, do I need that extra coat? Do I need that extra pair of jeans right now that I might go to Macy's and Herald Square and go buy? Probably not right now if I'm tightening my belt. It's kind of that difference between what you need to spend your money on certain food bulk items, and I wonder if that is part of what we're seeing out of Costco. Anyway, before we move on to rapid fire, anything there you want to jam on?
No, I absolutely think you're right, JD. I think we have seen anecdotal evidence over a number of years now that when consumer spending starts to sort of not contract, when consumers get a little bit more defensive in their spending, they will overreach in food items as they pull back on discretionary items. And we've seen that that evidence has been sort of replicated over a number of years now. And I think that's being evidenced in what Walmart is seeing in its grocery store market share gains, what we're seeing out of Costco, and as a result, what people are not spending in Macy's, brick and mortar stores, and elsewhere.
Yeah, that's a really good point. Love that part to button up that before we head on to rapid fire. Oh no, actually one more. Let's do this one real quick. Latest on MasterCard spending data. I think we'll get more of a sense on credit when the big banks report. But what do you want to hit here before we move on?
It was reasonably robust, up 7.6% going into that December 24th period. But what was interesting to me, JD, was actually online was well ahead in terms of growth rates than brick and mortar. I don't know if you'll remember that was quite a bit written going into the Black Friday season by myself in particular, that brick and mortar was going to outpace online growth, and that simply didn't materialize. That might suggest, and it's way too early to tell, and there's a lot to play for, but it might suggest that pandemic era shopping patterns are now becoming permanent, and that people just have a preference for those online purchases or online and curbside in a way that they didn't before, and in a way that is probably going to sort of indicate how people interact with the retail sector going forward. They may just not enjoy strolling through the malls, going through the shops, and spending the time required to find the bargains if they can just keep clicking, find the product they want, and have it delivered to their front door or simply pick it up in curbside. So those numbers really jumped out to me. The anticipation that brick and mortar was going to outperform, and it absolutely did not. That could be really important for the retail sector going forward.
Absolutely. Okay, on to rapid fire we go. First up, let's talk Goldman, the big takeaway from their announcement of 3,200 job cuts.
That's the expectation this week. 3,200 is probably the number that we're going to get to, a lot of it in banking, some of it in the trading division as well. The good news, I suppose, is that it's not quite as high as the 4,000 figure. At the deal-making data for not only the fourth quarter of last year, but the whole really was significantly lower than the record tallies we had in 2021. So that's a lot of banking fees that have gone wanting. And as a result, you are going to get a corresponding pullback in the cost structure of these banks as they try to mitigate that pullback. And of course, what the banks are going to say this upcoming earnings season will be absolutely JP Morgan, Citibank, and Wells Fargo on Friday, and then Goldman Sachs into the week after that. It's going to be incredibly important for the whole of the fourth quarter earnings season, but for the investment banks in particular.
Absolutely. Okay, number two is the FDA's approval of Biogen's Alzheimer's treatment, a game changer.
It certainly feels that way. This is a really important decision for a company that's been waiting for this kind of unambiguously good news as a result of some hiccups that they've had in their prior dealings with the FDA in these Alzheimer's treatments. But that market itself is incredibly lucrative, not only from an economic point of view, but people who have been suffering from this disease for a very long time been crying out for a treatment that's that is effective and comes at a cost that isn't necessarily prohibitive for insurance providers to participate in. So we do seem to be heading into a very good period of news for Biogen after some hiccups previously. The stock had a really good bump on Friday. It looks to be extending those gains again today.
Number 3, Martin, what is causing Alibaba's stock to jump?
This is a long time coming. China's been cracking down on the tech sector for a number of years now. Essentially, the government was a little bit unnerved by the power that these companies had in a burgeoning digital market, and as well as the influence, political and otherwise, that some of its billionaire founders have found themselves sort of exercising. Jack Ma being the perfect example. The richest man in China, one of the richest men in the world, founded Alibaba, incredibly popular. Essentially, what happened in the latter part of 2021 was that China began to crack down on these companies and to remove or abate the influence of Mr. Ma and others. Essentially, what Mr. Ma said over the weekend was that he was going to cede control of Ant Financial, which is an Alibaba subsidiary. That's probably going to free up Alibaba a little bit more from any of the anchor that it felt as a result of its association with Ma. But there were commentary over the weekend, particularly from the People's Bank of China, that said actually now they're looking to support the tech industry and its job creation focus as the company comes out, as China comes out of its COVID era lockdowns and needs to accelerate economic growth very quickly. So suddenly the tech sector is back in favor. And as a result, Alibaba, being the biggest tech company in Asia and by far the biggest in China, is getting a boost. Shares up significantly. We'll see what it all means for Mr. Ma. He's still, of course, the biggest shareholder in Alibaba. But the fact that the Chinese government is backing off a bit on its more restrictive actions to the tech sector is unambiguously good news.
Fourth and final, NFL playoff matchups are set. You and I are two happy campers today, aren't we? Which team takes home the Lombardi?
I don't know how we got in.
Because you and I have had this conversation so many times this year. We've both been like, Dolphins and Giants, what are we doing? Here we are, my man. Yeah. We got back-to-back games Sunday.
Amazing, isn't it? It's going to be a lot of fun. I don't think we're going to do terribly well. And if there's any indication that Tua Tagovailoa's health is in question, I don't think the Dolphins are going to play him, and they might just try to, put this in the bank and try again next year. But I think you guys have a better opportunity to go a little bit further. We just have the misfortune of probably facing one of the best teams in the league right now. For me, even though I would love to see the upset, I'm looking forward to that Bills Chiefs game because that could be absolutely epic.
Absolutely. To the point about the Bills, I think we can all agree. How incredible was it to see not just all these social media posts from Damar Hamlin and just the league-wide support, but my goodness, you could not script that Bills run back to kick off the game. The first play from that organization since that tragedy on Monday night. I mean, I think all of us have to. I mean, it really sent chills up my spine, Martin. I'm sure you'd agree.
Yeah. Did they groove it, to steal a phrase from baseball?
I don't think so. I don't think these guys are out there doing that at the NFL level. I mean, it was really an incredible weekend. And by the way, we got Georgia TCU tonight. You a college fan? We don't talk college ball a lot.
I do quite like it. I find myself slightly conflicted over this, not as a result of anything moral, but simply the fact that January, what's the date today? The 10th or the 9th? It's such a long way from the end of the college season that it doesn't appear to be sort of connected in any way to the college football that we enjoyed over the autumn. It's just such a long and arduous season, and teams that may be sort of teams were shut out of the playoff picture that might ordinarily have found themselves competing for this national championship. But not to take away anything from the teams that are going to be in the game. I mean, if TCU were to engineer this upset tonight, it would be really quite something.
They are 12.5-point underdogs for whatever. Wow. So not giving TCU a lot of a chance, but if there's a team that has played like a team of destiny this year, it is TCU. No one expected they'd be remotely close to contending for a national championship. I don't get the sense Georgia will be blowing them out tonight, but they are expected to win. We'll see.
Have you seen the size of the TCU players? I mean, everything's bigger in Texas, as we know, but these guys are absolutely gigantic.
And they play sound fundamental football. I've
Yeah.
gotten to watch a lot of their games this year. It's going to be the last round with the Michigan-Ohio State games were just two incredible back-to-back games there on New Year's Eve.
Amazing.
Sets the stage for tonight. I can't promise I'm going to stay up that late to watch, but I always say that, and I always do, and I'll be very tired for tomorrow's show, but it will always be worth it, as is every day we get to do the show. The great Martin Baccardax, thank you as always, my friend.
Thanks, JD.
You got it. All right, folks, that is going to do it for the Market Open. Stick with TheStreet.com for more on these and all of the major market stories that matter to you, and we will see you tomorrow.